Hello, everyone, and welcome back. It's been a while. Don't worry, I didn't get wrecked and give up. I've been focusing on the Taurus crew and developing further as a trader. Today, I'm going to be giving you a ton of value. It's going to save you a lot of time sifting through all the ICT's crap. So make sure you stick around for the whole video. I'm going to be talking through 3 ICT concepts I believe will fast track you to your funded goals. These 3 work synergistically and provide some extremely powerful results. Without discrediting the man too much, I'd just like to say that there's a good chance these ideas have been around for a long time in various forms or names. I don't claim to be an ICT expert at all, but regardless, these are trading methodologies I use every single day to trade the Nasdaq profitably. So let's dive in. The first ICT concept, which I find extremely helpful in finding a high time frame bias, is internal and external range liquidity. Internal liquidity refers to fair value gaps, or gaps as I'll refer to them from now on. External refers to highs and lows. Easy enough, right? Markets are in a constant cycle of rotating between internal and external liquidity. Recognizing this allows us to use it to our advantage when forming a bias. Next, I'm going to be playing you a clip from Wednesday's live trading room for London Open, where I discussed this before it played out. Okay, so on the weekly, I talk about how we rotate between internal and external liquidity. Well, on the weekly, it's a really good example. So you can see here, this was a big weekly gap that got taken out. So the natural draw on the liquidity is going to be this external high, these highs. So once that gets taken out and it's inverted, at that point, at that weekly close, you could have had it in your mind that the more likely you're going to come and take this. So it's a nice bias to have for the week. It's a nice way to look at it. You also see that you got some momentum in that. And then ever since, you can see, look, quick move out of this gap. Where do we go? We go to the next external liquidity, make another gap. Not the best move, but we do make a move out of it. Where do we go? Next external liquidity. What are we doing now? We've made a big bounce out of this gap. Where are we expecting? The next external liquidity. So you can see how that chain has gone along. So why would we think that this time is different? We may as well just follow the information that we're given. So from this, you can see that in the last week or so, we have skirted that high. So in my opinion, I think this high is highly likely to go, and I'm going to believe that until I see a candle close below here. So it's a fair old gap, but if you're looking at it on a weekly basis, it gives you such a really good indication of prices intentions, let's say. So you can see that we didn't even take out the previous week high from last week, obviously. So this is our current weekly candle. So now we jump down onto the daily, we get a little bit more information. Let's just take the weekly away. So now we can see we're also jumping out of this big daily gap here, jumped out of that, and we're still yet to take the external high, which is also obviously the previous week high and that external high. So for me, I know there's a draw on this liquidity. It's just a case of how do I act upon that, because I can't take trades with with minis or even micros. I can't take it and target weekly highs. I need to be in and out on the day. So it's just, I suppose it's a narrative of price. So if you understand that the draw and the narrative is higher, then it gives you a little bit extra confidence when you're looking for long setups. So as you saw from that live trading analysis on Wednesday during London Open, we got exactly what I was talking about. We had that external liquidity taken out. You see that on the daily, right there. Happened on the very same day. There it is. Exactly what we were talking about. So just to conclude this section, I've already showed you the rotation from internal liquidity to external liquidity, but what about the other way around? So we can have external liquidity to internal liquidity. And Bitcoin actually has a lot of really great examples of this. And you can see right here, we've taken out this high. So we've taken out that external liquidity. So the natural draw now on liquidity is going to be this internal here and this internal here. And as you can see, if we play price forward, that was where price gravitated to. So cleaned up that right there. And then you'll see this happening all the way throughout. Again. Yeah. Took out this low. You can just see this happening throughout the chart. Took out this gap here. Drawn liquidity is now up here. There it is. Now taking out the external liquidity. Drawing liquidity is now the internal liquidity. So jump straight into that. Taking out this internal liquidity here. Sorry, external liquidity. We're expecting next. See that here. Taking out the external liquidity. You can just see this happening constantly throughout. There's a great example here. You've taken out this liquidity all down here. All that's been taken out. Okay. You formed a nice gap there. What happens then? You then take that out. See that? So the next draw on liquidity is going to be this high here and this internal liquidity here. If it can take out this internal liquidity, then the next draw on liquidity is going to be here, and you'll see this playing out beautifully. There it is there. So naturally, our draw on liquidity would be this gap here that formed. But as we know, price is quite bullish. We have jumped down into this area here. So if I jump onto the weekly, you'll see that this is a weekly gap right here. That has been taken out. So if I just quickly remove that, just so it's nice and clear, you'll see that the internal liquidity has been taken on this weekly chart, cleaned up some inefficiencies. So the natural draw on liquidity now is higher. So the weekly tells us up. Let's get rid of that. But the daily says, okay, well, we might go down first, but there's potential we still move up because the weekly says up, but the daily says down potentially. So is time power in this instance? We find out, yes, we're running into this internal liquidity now. Can we get past that? Yes, we do. So once that closes there, you can see that now our draw on liquidity is going to be this high. And that brings us to today. So just through simple acknowledgement of the internal and external liquidity, you can see where price is likely to gravitate towards. So in this instance now, I expect new highs for Bitcoin. Inversions. The second ICT concept you need to help you get funded. I have already glossed over these slightly in the previous one, but these are what form the basis of my execution. The power they have in helping you establish bias, strength or weakness in price action, confidence in a trade with a mechanical rule set. It's literally life-changing from a trading perspective. So pay attention to the rules I'm about to lay out for you. So what are the rules? Well, first of all, we're going to look for liquidity to be swept or taken. That's rule one, okay? It's very, very important. Step two, we identify a single and obvious gap. This is our gap right here. Step three, we enter on an opposing candle close. So you can see here is our candle close. It closes above the bearish gap. Therefore, our bias is now flipped to bullish, okay? So if this bearish gap was to have held, we would be expecting a rotation from internal to external liquidity. But since the internal liquidity has been broken, we now expect a rotation to the next external liquidity. Okay, so you can see gaps as almost like your middle ground. You can be bullish above and you can be bearish below. And this comes into the invalidation also. So if you were to play this inversion here and you were to look to get long to play to the next external liquidity, but price decided to move down, then if there was a close below the bottom of the gap, then it would invalidate your play. So, of course, no strategy is perfect, and this one will yield losers too, so it's important to be aware of that. There is a few more nuances to this strategy that I won't go into particularly in this video, but if you want to learn how I use them in particular, using multiple time frames, how I find momentum in the trades, then come and join the crew and find out more. But as you can see, this is a fantastic setup. We take the liquidity, we invert this gap, and then we start moving up with momentum. So really, really good way of playing this one. Okay, so the third and final ICT concept you need to get funded is power of 3. This is best utilized around the early hours of the New York AM session, also known as the kill zone. During this period, you're typically going to get the best setups as volatility and opportunities are plentiful. These sessions can be a little bit scary if you're unprepared, so that's why it's imperative you go in with a plan and do not deviate. I personally like to be at my chart for 2 p.m. UTC and be done by 4 to 5 p.m. This enables me to utilize the 80-20 principle by getting 80% of my results from only 20% of the time I spend working each day. The power of 3 takes into account the market price action during 3 phases: accumulation or ranging, manipulation, and distribution. You can see that here we're ranging. We make a move down, take out some liquidity, suck in some shorts, and then we distribute. We move up and we take the other side of the range. This example is a little bit fuzzy because obviously we've got this news wick here, which I'll obviously always be aware of. That tends to be why I start trading at 2 p.m. because I tend to miss the news releases at 1:30 p.m. UTC. So I tend to take that data into account, but I don't like to trade from that data. So I'll go on and show you a few more examples now. Okay, so starting out with a bearish example here, we have our accumulation range. We then have that manipulation up. We take out some liquidity above here. We suck in some late longs, and then what happens? We distribute onto the other side and we take out the liquidity. So as you can see, this is a really great model for utilizing reversals. You know, this is happening again around the London close to the New York Open first couple of hours. So typically this is where you're going to find the best trades. You know, if you're just trying to trade Asia and London, you know, you've got pretty lame price action, but as soon as 1:30 begins to roll around and you get that news release, well, then you get that manipulation up and then you get that distribution down. So, you know, a really, really nice framework to use. Here was our first example from the previous slide. This one was a little bit iffy because you have got this this news wick here. I tend to obviously start my trading day at 2 p.m. so I get to use this data because more often than not the data comes in at 1:30 p.m. UTC, so I like to react from that data as opposed to trying to trade with it, which is very difficult to do and pretty much a gambler's thing to do. But yeah, you get that accumulation, you get that manipulation, you get that distribution. Okay, very, very common pattern. So there's another few examples up here. Where are they gone? So here's another one. There's your accumulation, there's your manipulation, and there's your distribution. Take out all liquidity here, suck in some shorts, distribute, stop them all out, and take the liquidity along the top side. Okay, here's another one. Accumulation, manipulation, distribution. Okay, simple enough. So to conclude, I'm going to show you now how we put this all together to find optimal trades and maximize profits. Starting out on the daily here, what are we looking at? Well, as we saw in the first section, we're seeing a reaction from internal liquidity. You can see there's a nice big engulfing candle, this one right here. So our natural bias is going to be drawn to this external liquidity. Okay, so on the day, we come to our computer and we see what is the price action giving us? What data are we being provided with? Well, first of all, clearly we can see there is an accumulation range forming. So next, we'll just be simply waiting for New York Open. Like I said, 2:30 UTC. We'll be looking for that potential manipulation leg to form. We'll then be looking for our entry model and then that potential continuation and distribution. So as we can see, we get that manipulation leg. We then jump down onto our lower time frames and monitor price action. You can see right here, we form some relatively equal lows. That would be nice for a sweep of liquidity. Always marking out the local liquidities. You see that here. We're just still waiting for New York to open. You'll notice as soon as we cross 230, there will be a big injection in volume and volatility will be imminent. So once that happens, you can see that we immediately reach for liquidity. There it is, swept liquidity. And then we can also see that we get our clear and obvious single gap that we can use for an entry model. If we invert that gap, we'll be looking to play long and potentially ride up that next leg of the power of three, the distribution. So wait for that to happen. There it is. We can enter our contracts there. Bit of a recommendation, I recommend using micro contracts because you can use multiple contracts. This will allow you to take multiple take profits, which is ideal, of course. Our first target is going to be the external liquidity, as we've already discussed this particular example. But with multiple contracts, we'll of course be looking up to additional liquidity higher. We'll be looking up to this high up here also, where we can take profits. So let's play it forward. You see, we take that out almost immediately. So what we're going to do, we're going to take some opposition off, secure the profits, move our stop loss to break even, secure the trade, and then we'll let the rest play out. There'll be another take profit at this point, of course. We could probably cut that in half. And then we've still got one to ride up to the potential of taking out the other side of liquidity. So the top of the accumulation range that we've already discussed. That would be our final target, of course, and eventually we do take it. So a very successful trade using the simple concepts we've been talking about, which is the power of three. It is the inversions for our entry models, and of course using the high time frame bias to help us have confidence in which direction price may be wanting to trade. And that's it. Thank you for watching. Please hit like and subscribe. Join the crew at Soros Crypto, and follow me on X if you want some more regular updates, some shit posting, all that good stuff. Yep, thanks again for watching, and good luck.